Welcome everyone, and thank you for joining us to this special webinar. My name is Ayal Cohen, and I'm heading the marketing efforts of our firm, Gross & Co. law firm here in Israel, Tel Aviv. We are hosting this exclusive webinar together with Lincoln International and are going to discuss today the trends and best practices of international M&A transactions in 2021. Before we start, I would like to welcome the panel members that we have here today with us and introduce them to you. So I welcome you to open your cameras. Great. So on the Gross & Co. Team, we have Dr. Ayal, Shenhav, co-managing partner and head of the high-tech and venture capital practice in our firm. Richard J. Mann, partner and head of M&A department. Oren, Biran, partner and head of tax department. Together with us, as I mentioned, we have Roger Knight, managing director from Lincoln International. And we have a special guest today, Gabby Nizri, former co-founder and CEO of Ayehu Software Technologies and CSO of Resolve Systems. So I hope you will enjoy the webinar today, and I invite Dr. Ayal Shenhav.
Thank you, Yarden. Thank you, and welcome everyone. I'm very excited. I think it's a very interesting opportunity to learn about M&A best practices. We initiated this webinar because we closed a transaction recently in which Ayehu software was sold to Resolve Systems. We were fortunate to work with Ayehu for many years and represent Ayehu from inception until the exit, and Gabby was the CEO of Ayehu. It turned out that the buyer actually approached Rick Mann, my partner, and asked him to represent Resolve Systems in this transaction. So we actually got conflict waivers, and we were on both sides of the transaction on this one. And we were fortunate to have Roger Knight with us on this transaction because Roger was the investment banker from Lincoln International who represented Ayehu and was able to connect them with Resolve and make the deal happen. And during this transaction, we became very good friends, and I'm happy he joined us, a big basketball fan, just like myself. So that's kind of the background. And what we want to achieve today in a 1-hour session, obviously it's a very big topic, dealing with M&A, is to kind of highlight a few key topics and trends in the M&A market in Israel, in the US, and try to share with our experiences with the collective, all the participants. And that's the background. And I want to kick it off with Roger. Roger, maybe just a few words about Lincoln International, who you are, what you do, and then educate us a little about what's going on in the M&A market 2021 from the US perspective.
Absolutely. And thank you, Dr. Shenhav. And it's good to be with everyone here. It's really exciting to be back with the Ayehu deal team members. And, normally it takes a 12-hour plane ride for me to be in front of a lot of Israelis. I guess my family would be on the better side of that not being the case. So we are in a virtual world, and we're taking advantage of it. Look, it would not be an investment banking meeting if there wasn't a commercial. And I do happen to be part of a global international investment banking firm by the name of Lincoln. We're a 25-year-old firm headquartered in Chicago here in the US. I'm joining you today from Park Avenue in Midtown Manhattan. So it's great to be on the panel with such talented people, including the Gross team and obviously our client, Ayehu. It also would not be an investment banking meeting if we didn't have some slides for you. So, with that, allow me to just share my screen and to give you some perspective. So Lincoln is, as a firm, focused on the M&A markets. And in general, we are advisors to primarily sellers on transactions. I'm a partner of about 100 within our 750 professional team. I focus specifically on technology, and for the last 20 or so years have covered enterprise software. So without further ado, maybe I will kick off with a little bit of a overview of what we're seeing today in the current technology M&A market. I direct your attention to this slide, which highlights annual both deal value and volume over the last, call it 20 years. And you know, with the pandemic, obviously there was a lot of anxiety and uncertainty with where deal activity would be, not only current but for the future. And what we've seen and what this slide shows is that 2020 volumes, not only on a value but on a deal count basis, were up, and that's actually very consistent with Lincoln's experience, not only in technology but across all 6 industry groups that we cover. 2021, bar none, has been a boon, mostly for technology, but also other areas. And you see it here on the right. You know, it's a little bit of a visual cue. You notice the 3,000 or so transactions that have happened in the first 9 months. That's actually up almost 10% from the first 9 months of last year. And we wholeheartedly expect to see volume for this year exceeding last year. And obviously, from a value perspective, you can see a tremendous uptake in the number of deals within technology. Now, one point I'd also make is this is global data. It's actually provided from a trusted service provider that we've partnered with, the 451 Research Group. And you know, another thing to keep in mind is, you know, the U.S. tends to represent about 2/3 of the transaction activity. So a meaningful amount of deals, a definite U.S. component that's driving activity, and as you see, values are going up and to the right. On a quarterly basis, I think it's actually interesting to look at this because going back 6 quarters to Q2, there was obviously a lot of uncertainty, a lot of anxiety as to what exactly was going to happen with the onset of the pandemic. And you know, you notice the volume of deals didn't recede that much, but the values dropped precipitously. And then on the flip side, as you look at the last 5 quarters, it's been a tremendous uptick. The amount of activity and the size of deals has really been a noticeably different environment. So one question you'd ask is, okay, well, what's really, you know, behind these numbers? What's driving this large increase on a value basis? And it's clear deal sizes continue to creep higher. And this slide does a really nice job just highlighting exactly how many deals are getting done above $1 billion. And you know, not only do we see this on a macro level, you know, we Lincoln are seeing it even in our business. You know, a lot of our former clients, as they continue to transact with private equity, you know, it is very typical for us to represent a company 3 or 4 times as the business continues to grow and as the business continues to see new private equity sponsors come in and come out. And a lot of that has created higher value transactions. You know, you could also see a rise in the SPAC market. Now, clearly that market is cooled from an issuing perspective, and we potentially could see a different environment there. And you know, the last point is the serial acquirers continue to be extremely active in this market. We saw a bevy of large deals in Q4 and Q1 in particular. You know, I think of companies like Slack and Salesforce, you know, definitely dominating a lot of the airwaves or publicity. So this gives you at least a glimmer as to the backbone that's driving the growth in the market. The other context that I think would be important for us to at least consider is we've had a very strong and robust equity capital market. And you know, as this slide depicts, if you just look at something simple, the S&P 500, you know, it's pretty obvious to see that there is some correlation not only between value of shareholder value on the equity side, the public equity side specifically, but then as you look at shareholder value that's being created from an M&A perspective. Last and not least, and I certainly open it up to my panelists for perspective, but as we think about valuation, it is clear that deals are getting done at very seller-friendly, robust valuations, frankly, that we have not seen. This slide is indicative of that. There's a couple things I point out. Number one, I'm a software guy, and so clearly software deals have not been getting done for 2 times revenue for the last 10 years. There's a lot of technology companies that are behind this data, namely other sectors of technology such as hardware or even professional services, IT services that trade fundamentally different than a software business would. Number two, the trend line is very important, and clearly 7 times versus 2 is an order of magnitudes different. I'd even go back 1 and say, for whatever discount there may have been last year, given the effects of COVID, it's clear that whatever discount there was, the flip side is true, and we're seeing premium deals get done in this environment. The last thing I would say, and we're seeing this on a very company by company basis, the business models of technology companies has changed dramatically. Gabby can attest to this. As a software entrepreneur and exec, we've seen companies cross the chasm of selling perpetual license into subscription. We've also seen, hardware companies that were historically a point-in-time sale adopt a recurring business model. Cisco would be probably one of the largest examples as a publicly traded company. And the fundamental shift in that is investors, both strategic and financial buyers, love the predictability and the visibility of those models, and that's reflected in value. So we could go on for quite some time. Clearly, I'm an excited member of the M&A community as it relates to technology, but hopefully that gives today's group a little bit of perspective on what's driving deal value and volume, and where exactly multiples are currently in the marketplace.
Thank you so much, Roger. This was extremely interesting for me, and I wasn't aware that the multiple went up to 7 times revenue from 2 times something, and it's quite tremendous, quite amazing. So I think that gives us a good understanding of what's going on in the U.S. market. I'm moving now to Rick Mann to give us a little about what's going on here in Israel, and how close are we to the U.S., how distant are we from the U.S. on the M&A side. Rick, you're on mute.
Sorry. Okay. Thanks very much, Ayal. I think just to pick off really where Roger left off, I mean, what we're seeing in Israel is very similar to the trend that Roger pointed out in his presentation. We're seeing very, very high valuations, numbers that we've never experienced before. I mean, I think if 3 years ago, if you asked me to tell you how many unicorns there were in Israel, we probably would have said just about 10. And I think if you ask me today how many unicorns are, first of all, I can't give the answer because there's so many and some of them are not yet public, but I suspect that it's in the area of, could be as much as 50, 60, 70 unicorns. So we're talking about a world that's changed very dramatically in terms of valuations. We're seeing much larger investment rounds even before absolute acquisitions, but in very large investment rounds, which means that a lot of companies are sitting on very substantial cash accounts. Which means that both in terms of leverage in negotiating an M&A, there's less pressure on the company management and the founders to sell, or for the investors to sell out. And there's also a parallel trend, which we're seeing where the companies, after raising large amounts of money, are now going out and doing their own acquisitions. So relatively young companies can now do acquisitions of smaller add-ons because they're sitting on a cash chest, and I think that changes the dynamic as well. One of the other phenomenon that we're seeing is the growth in secondary rounds, in later rounds, pre-IPO, pre-M&A transactions. Secondary rounds essentially change the balance of power between the sellers and the buyers, because the sellers are under much less pressure to sell out right away. If the founders themselves have been able to take some cash off the table, then again, their pressure to sell is reduced. They have taken home some money. They changed their they can show their family that there's actual value there. And on the other hand, they can be a little impatient together with those investors that are willing to wait for longer term returns, a little more patient in terms of their selling their company. And therefore, we're seeing M&A transactions where the seller has increased power in the balance between sellers and buyers. I think that just in terms of legal ramifications for all that, I mean, at the end of the day, a larger transaction is not different legally than a smaller transaction. But I think there are some consequences for these very high valuation transactions. One is they tend to move very fast. The market's a very fast moving market, which means that companies that are positioned before they enter into a selling process from the legal side, that is, they have their ducks in order. They've prepared themselves beforehand. They know what issues are likely to be problematic and have addressed them, and they know what issues are their strong suits, are likely to be able to take advantage of markets that are ready to move very rapidly. From the Israeli environment, there are a couple of areas which tend to recur where some attention is needed. On the one hand, obviously, anything related to IP. The vast majority of acquisitions in Israel are still IP driven in the technology space. That is, acquirers are looking for access to specific technology. And therefore, whatever needs to be done to make sure your IP is in order should be done ahead of time. The classic obstacle or the classic stumbling block for Israeli companies is IP that may have been developed while somebody developing it was still employed by a university or a hospital. And that raises certain questions about the ownership of the IP. That's just one example, but the first is IP. Second of all, workforce. We know that a lot of the acquirers of Israeli technology companies are looking for IP on the one hand, but at least as important, they're also looking for the workforce. They're looking to be able to build an R&D center, even if in the end, the technology that currently exists in the company doesn't prove itself. And so making sure that your employees are set in terms of employment agreements, in terms of invention assignment agreements, and in terms of options and incentives and how those are going to work in terms of an acquisition. That's all very important planning before you get started. Beyond that, I guess we should also mention the SPAC trends. In Israel, SPACs were extremely strong in the beginning of this year, but we are seeing a slowdown in SPAC activity. It has not disappeared. We ourselves right now are working on one SPAC, which I think will be very promising and has a very high chance of success and a very nice valuation. But the market has cooled there. I suspect that there will continue to be SPAC transactions because there continue to be SPACs who raise money. But I think they may be more selective, and I think that closing those transactions may not be as easy as they were before. Bottom line, market is booming. It's great for everybody who's part of that ecosystem. And I think that there are challenges, but I think that the system is ready to meet those.
Thank you so much, Rick. And as you mentioned, we see a lot of unicorns. Just as a firm, we just closed 2 transactions with 2 companies, each valued at $4 billion, which is almost unbelievable and unheard of even 12 months ago. So it's crazy. So I want to move back to Gabby. And Gabby, well, you founded Ayehu, I think it was 2006 or 2005, and decided to move on to an M&A transaction in 2021 and closed it successfully. So congratulations. But maybe you can share with the people on the webinar what initiated this decision. Why did you decide to take an investment banker? How did this all develop?
Absolutely, Ayal, and thanks for having me on this panel. Actually, this panel reminds me the final days of closing on this transaction. So this forum actually kind of deja vu, which is great. Like you mentioned, it was a very successful transaction.
Okay, we're still friends. It's good.
Yes, we are still friends. That's actually a good outcome of M&A transaction. But let me start with kind of a quick introduction. You mentioned we started this company back in 2007. Okay, myself and my co-founder Oren. It's been quite a journey, right? For 14 years until we came to this decision. A little bit background. So obviously co-founder and CEO of Ayehu. Prior to that, I was running IT operations 24/7 for too many years. So the decision to start a company was based on a pain and many scars on my back. But I can tell you many scars on my back in the last 14 years running a startup, a lean startup. And Ayal, you've been there from the day one, and we didn't raise a lot of money. So obviously, kind of out of the reasons of going through some kind of transaction like that is actually, to look for a source for the money. So you could actually end up maybe, doing some fundraising, but also M&A transaction is a very legit option to grow your business, right? So, so that's kind of a background. Now, we could write a book, and I think we don't have time now to go through the entire reasons of why we actually decided to go and make this transaction, but definitely there are some, obvious things that you have to have, in order to even think about M&A transaction. There are two sides of this transaction. You have the purchaser, someone who is willing, actually, and ready to buy your business, and obviously you, the company, which you should be ready also to sell. And so let's start first thing first. Myself as a founder, and obviously I have a co-founder, and this is a critical decision for us, right? This has been, as I mentioned, 14 years of my life, in our life, and we basically put everything as secondary. And our families and friends and everything else wasn't matter as much as the success of the startup. So obviously we were dedicated about that. And now we are in very important kind of position. We have to make a decision, which will, I think this most likely, probably the most important decision I had in my business life. And so all the work that we have put together, all the risks that we have taken, and now the decision, if it's worth it and giving it away, is this the right time for the company and for us to move on? And are we ready to let it go, right? So it's really important to get to that point of decision, yourself as a founder and co-founder. If you have more founders, it's even more complicated to decide to let it go, okay? Once you have that decision with yourself, the next actually phase is bringing this to your board, okay? Now that you're ready to make this kind of major decision of yourself, you actually need to get the majority, if not almost everyone at the board level, to agree. This is another milestone. This is a big decision for the company. And remember, the company is not only the founder or the co-founder, it's everyone. It's the employees, the customers, the partners, and of course, the shareholders, and everyone else that was involved in this company. So you need to think about all of these scenarios and the outcomes of such decision, okay? And, maybe, probably find the right reasons to do so. I think Rick mentioned one of them, but there are actually many kind of aspects deciding whether to go or not to M&A transaction. And I will name probably the major three of them. But before we go there, just to recap, the first phase is actually that you, and if you have your co-founder or co-founders and the board needs to make that decision, going and exploring M&A transaction. And by the way, this is where here we decided also to go with Roger and Lincoln and team. And this is another chapter in the book. We'll get back to that at some point. But right now, assuming we have been approached by a potential purchaser who has one or more reasons to do such a transaction. Okay, one is the ability to access to new technology or new IP, technical capabilities or unique solutions, where actually the purchaser can save tons of time, sometimes even year, to get to the market very quickly and save on critical time. So that's one aspect. The second aspect is the acquisition or acquiring new talents, either local or remote, Israel has great access to pool of talents. Okay, many purchasers are looking at, in Israel as a strategic place to build their headquarters, innovation headquarters, incubator headquarters, and so on. So Israel became already many years ago a strategic place for acquirers to make those M&A transactions. We were actually lucky, and I'm very grateful for Insight Partners who came maybe 3 years ago to Israel and put lots of investments and resources into the Israeli market, and they actually backed our transaction. So it's really important to understand that, Israel is a very strategic place to be in. And I think, that one of the reasons are access to talents, resources, etc. And finally, that might not be for every startup company. Maybe the purchaser wants your customer base. A customer base could bring you into new market segments, to verticals, an expansion opportunity. For example, if the purchaser has products and they would like to maybe use the customer base to sell those products to, and vice versa, by the way, it's bi-directional transaction, which means that our products can also go to the purchaser's customer base. So customer base is very important. For Ayehu, I think all the three reasons were actually relevant. We had the perfect fit as well as timing. The timing was very critical as well. Purchaser, kind of time window, sometimes it's maybe few months, even like maybe 3 months, and you have to get to the point and the right time. And I think, Roger, you remember, the timing was everything in our case, right? And we happened to have also the perfect match between what the purchaser was looking for and what the seller was selling. Okay, so I think, I would argue that maybe the biggest challenge for every M&A transaction, no matter the size of the companies, is the team integration. The people who are actually being moved from one company to maybe a bigger company, okay, distributed all over, and basically going into some unknown. This unknown and the fear is one of the maybe reasons for failure transactions.
We will talk about the integration later.
Yep. Exactly.
But this is also always very interesting. I was fortunate to work with you for 14 years on this startup. It reminds me that Jacob worked 14 years for Lavan. It's the same concept. It took him only 14 years to get rid of Lavan Arami, but I didn't think about it before we spoke. 7 years for Leah and 7 years for Rachel. It was the story. I don't know how to draw an analogy or not. But this is great. And I want to move to Oren. Oren is obviously head of our tax team. And Oren, Gabby calls you, he says, I want to sell Ayehu. Or Roger calls you, says, I want to sell Ayehu. What are the tax issues and what are the main drivers of the tax structure and of the transaction?
Yeah, sure. Hi
What are
to
the
all.
key issues you have to think about when you start this process?
Definitely. Thank you all. First of all, I think that I will divide it into 4 phases. Number 1 is the tax due diligence. This is a very important stage as this phase needs to run detailed review of the various tax aspects of the target companies, global operations, tax arbitrage, tax returns filings, net operating losses, where is the IP location, transfer pricing between the companies and related parties, stock option and compliance. Any significant risks identified during the due diligence provide an opportunity to negotiate structure and, of course, indemnification clauses. So this is a very important stage to run a due diligence. And of course, companies prior to going for M&A should review all the files and all the risks before going into the M&A transaction to be prepared in advance to the M&A. This is number 1. Phase 2, I would say deal structure planning. Once the deal moves forward from the due diligence stage to the planning stage, The question is how the deal will be, whether it will be an asset purchase, whether it will be stock transaction, merger transaction. This is critical issue for all the parties involved, to the buyer and to the sellers. For example, if you are doing an asset transaction, then we have a corporate level tax. So we are paying corporate tax. Of course, we can deduct NOLs if available. And then distribution, the money to the shareholder, there is another level. So 2 levels of taxes could apply if we are doing asset transaction. By the way, to the purchaser, this is the best structure because the purchaser is getting stepping up with the basis of the assets. So we can deduct this expense. So this is better to the buyer, but is not the.
I think it's a very important point. Obviously, a share transaction results in a capital gain to the sellers and a less reduced tax compared to an asset transaction, which results in double taxation. And just to give numbers, asset purchase would be around 45% tax. Stock transaction would be around 25-30% tax for the seller or the founder. What's more common? What do you see in the market? You see more asset purchase?
We see more stock transactions. Of course, there are sometimes cases of asset transaction, and if we are representing the sellers, we're trying to do the best efforts to change it into stock transaction because, as we said, this is the lowest tax that the shareholders would pay if we're talking about Israeli sellers. It's capital gains between 28 to 33. If we're talking about non-Israeli sellers, there could be exempt from tax in Israel. So a stock deal is the best for the sellers.
So I want to say, again, I agree with Oren. Most transactions are stock deals. When we represent the sellers, we're very adamant about it because the tax savings are huge, and we have to obviously make sure that due diligence doesn't create any issues, and the buyer is happy to buy the shares, but it's a very, very key point for the transaction. Otherwise, the tax is, especially for founders and venture capital funds, it's a disaster.
Correct.
Maybe just interesting, this week for the first time in my life, we have sellers that came back and asked us to convert a share transaction into an asset deal. I think it's a unique set of circumstances. We don't yet know the real reason, but I suspect it's a company that's controlled by a small group of people who already have a lot of resources. And I suspect they want to keep the losses of the company and use it as a vehicle for something else. That's the first time that that's ever happened to me, where a transaction with a small private company, the sellers came back and asked for an asset deal.
Yeah, indeed. This could be a reason to do it. Post-acquisition, I would say tax consequences to the buyer, because he is now holding the company, and he can use IP, transfer pricing, or net operating losses as well. Now, phase 3 is, in this part, we are reviewing and making analysis of the tax implication to the stockholders. First of all, it could be a transaction of a share swap. Share swap, it means that we don't see, for each shares I'm holding in the company, I'm getting new shares in the buyer. Of course, this is a taxable event because you are changing your shares. However, there is a way to get a ruling, I would say, or to structure the deal in a way that no tax will be on such exchange, and the taxes shall be deferred to the date that I will sell my shares in the buyer in the future. Of course, there's few conditions to meet this structure, and a transaction which does not fall into deferral track, of course, will require us for creative ideas because in a swap transaction, no one sees cash and you cannot pay the taxes. In Israel, there is certain code sections that allow you to make this transaction under certain conditions with no tax liability, I would say, at the date of such exchange. If you are talking about cash transaction, then what is customary is that the buyer enforce withholding tax. So each shareholder is subject to Israeli withholding tax, even though, for example, let's assume a non-Israeli multinational is buying a US company which holds an Israeli subsidiary, the market is that a withholding tax mechanism will apply because of the Israeli subsidiary in most cases. And therefore, there are some mechanism, I would say, to avoid this withholding tax through using a paying agent, Israeli paying agents, that the cash will be transferred to Israeli paying agent, and each shareholder shall have enough time, typically 6 months, to provide the paying agent with reduced withholding tax or exemption from withholding tax from the Israeli tax authority. In general, non-Israeli sellers should be exempt from tax on selling their stock in an Israeli company or Israeli-related company. But for that purposes, they need to approach the Israeli tax authority and to ask for this tax exemption. In most cases, we also see founders, of course, selling shares. Then there are a few issues that need to be addressed. First of all, reverse vesting. Founders with a reverse vesting on their shares may have issues, I would say, or need to be reviewed carefully whether they are meeting the condition for capital gains on the sale of such shares, instead of applying tax with as compensation income, which is marginal tax rates. This is number one. Number two, a lot of founders made relocation from Israel, for example, to the US under Israeli tax law. Even though you become a US person or you terminated your Israeli residency, there is a section 100A which says that you, on the date that you are selling the shares, you're liable for tax in Israel. So the situation is, for example, an Israeli person moved to the US and he's holding shares in a US company with Israeli subsidiary. Then after a few years, he's selling his shares in the US company. Even though he's a US person and selling shares of a US company, under Israeli tax law, he is subject to tax in Israel. And of course, as a US person, he's subject to tax also in the US. So this issue is very, I would say, it's something that needs to be reviewed to avoid double tax situation. And in many cases, we need to plan it in advance. So the founders or the employee that moved from Israel to the US and holding options, the same issue applied to the options, stock options, and on cross-border, I would say, transaction. The last point I would like to add is what happens with the employees. They are holding stock options of the company, some of them US-based employees, some of them Israeli-based. As we know, Israeli, it is common to grant options under Section 102 within the transaction. These option holders selling their options and shares. On that regards, since some of them do not meet the 2 years lockup, under the Section 102, there is a requirement to meet 2 years lockup as of the date of grant to enjoy capital gains. So there is opportunity and to get a tax ruling from the Israeli tax authority. I would say, even though that you are not selling within the 2 years, you still can enjoy from capital gains. There is some issue if you are granted options within 90 days before the signing of the agreement, you may be subject to marginal tax rates on your options. So need also to be very careful with the stock options. The next phase is tax matters in the agreement. As you know, M&A transaction is backed with an agreement, and this agreement, there are a lot of tax issues such as tax representations that seller is providing reps to the buyer on tax compliance, on payment of tax, on withholding, on net operating losses, on entitlement for tax benefits, a lot of issues. For example, who will lead the tax contests after closing, assuming the tax authority is coming and saying the company is liable for additional taxes. Then it was represented to the buyer. So the question, who will lead it, and how the process would be. What will be happen with tax refunds? Let's assume that after a few years, the tax authority refunding the company with some taxes. Who will get it? The shareholders. Is this will be added to the consideration payable to the sellers? And last point I can mention is the indemnification. This is a very big issue on pre-closing taxes, on withholding tax, on breach of tax representation. And this is a major point that need to be addressed in the M&A agreement and the transaction.
Thank you. And I think this is, you highlighted a lot of the key issues and the complexity and the importance of the tax structure. Just going back to the issue of the stock purchase versus asset purchase. One of the challenges in a stock purchase is that everybody has to sign. All the shareholders have to agree to sign the stock purchase agreement. And that always creates some questions. If you have a lot of shareholders, potentially one of them or two of them may not sign. But then obviously, how do you force them to do it? So these are some of the questions we have to face. Also mentioning a third structure, which is a merger, which is very common in US transactions. Unfortunately, in Israel, the merger law, the companies law, which has a merger provision in it, is not very good. It requires the company to wait 50 days from the filing of the merger until the closing of the merger, and that's a long time. And it delays things, so we don't like to use a merger, which is a shame. I think we should think about changing the Israeli law and making the merger much more easy and efficient, because then only the majority of the shareholders to sign, not all the shareholders, and that's the US technique we should try to implement here in Israel. So there's a lot of things to talk about on the tax side, but unfortunately we don't have that much time, and I do want to move on and challenge Rick and Roger about some of the key terms in M&A transactions. And I kind of wrote to myself 4 topics, which are always interesting. One topic is the escrow and the size of the escrow and the time and the length of the escrow. What is in the escrow? What is outside of the escrow? Buying reps and warranties insurance as an alternative to escrow. And last but not least, the Israeli Innovation Authority, what you used to call chief scientist. So these are kind of 4 topics which we do a lot of M&A transactions, come up all the time. So starting off with the escrow, Roger, Rick, why do we need an escrow, and how big is it, and what time does it? How long is it?
That's great. And Rick, feel free to chime in. I guess to make it come to life, one of the things that I would suggest is, look, if you are an entrepreneur like Gabby, or let's say you've bootstrapped your business, or you've taken institutional capital, in either of those scenarios, indemnity and what you do with it is important as a seller, right? Be it if you negotiate your deal for 3 times revenue, 7 times revenue, or 14 times revenue, if the buyer has an opportunity to recoup those amounts, goodness forsake, on unlimited amount, I question whether or not you'd consider that deal. Or as your advisor on the sell side, I would certainly advise you to a situation where you could limit some of that risk profile. And so, it comes to life in the agreement, but certainly beyond purchase price, we spend an inordinate amount of time talking about, to what extent do we have a mechanism like an escrow that creates an opportunity to limit some of the risk profile for the economic, underlying of the deal. So, Rick, I'm sure you have some thoughts, but
Sure.
Perhaps that helps the group appreciate what the indemnity and escrow matters are all about.
Sure. I mean, I guess that really ties into the third point that I mentioned, and that's the reps and warranties insurance. That really came about originally from fund investor sponsors selling out. They had the need to get their hands on the money clean and be able to distribute it to their investors. In the United States, it's become very prevalent. I don't have statistics specifically, but it's very prevalent. And the truth is, I would say in the last year and a half in Israel, we've started to see a large increase in rep and warranty insurance, probably because we've seen so much involvement of foreign players, either acquirers or investors who are part of the selling group. And the rep and warranty insurance provides a very good solution for many, many companies. The premiums are not that large. And I think it's something that everybody doing an M&A transaction should be considering.
Yeah, I would totally agree. I mean, from an anecdotal basis, just thinking about the 9 or so transactions I've been a part of in the last 18 months, I'd say two out of every 3 include rep and warranty insurance. Something that's maybe a little bit more programmatic. Rick, I'm sure, and Ayal, you track this, but the ABA has a really nice survey of private deals, and even there you start to see, the 2017 report, it was probably 1 of every 4 deals included it. The most recent survey I've seen, which is pre-COVID, suggested one out of every 2 deals included reps and warranties insurance. And I tell you, for those deals that are auction processes with high amount of seller leverage, we're starting to get into situations where, reps and warranties insurance becomes the sole remedy, number one. Number two, you reference the cost. We typically see the cost based on the insured amount on a percentage basis being maybe 2.5% to 4% of the insured amount. And so those sellers with the most amount of leverage, they tend to pay no more than half of the premium. And in some cases, that's a complete buyer expense. So, going back to your first point there, Rick, sellers love, liquidity on day one, at 0 encumbrances, especially if you're an institution that's in the business of distributing to limited partners. And, in some deals where founders own a significant amount, they're not looking for some gotcha that comes up 12, 18, 24 months down the road, where all of a sudden they have to, pay the piper. So, I tell you, beyond price, indemnity and escrow can become very contentious. I would also say on the flip side, with the insurance, there are some benefits, obviously, but there's also some pitfalls. And I think of one deal in particular that we recently announced and are soon to close, where you can get yourself into a really tricky spot because going down the insurance path allows for diligence from the insurer. And what happens when you get an exclusion on that policy, and how are you going to treat it? So, those can be potential speed bumps if you don't prepare well in advance for it. And, to the extent that you have an issue, then you're back to square one as to how do you deal with it?
In terms of speed bumps, I think the classic case is tax exposure. That seems to be the issue that most challenges rep and warranty insurance. So if you know that you may have tax issues, or you haven't been audited in a long time and there's exposure you can't exactly measure, or there's a specific issue out there, I think those are that's an example of an issue that can be a little bit challenging. But I do think we're going to see the trend continue. And until we hear, there's not that much traction yet about how claims work, and particularly in the Israeli environment. Until we build up that traction, I think we're going to keep seeing more and more. And then at some point, someone's going to have to evaluate whether or not it's really effective or not. I think right now the assumption is that the claims made are relatively small, and there hasn't been a lot of contention around those claims.
I can just share with you, we worked on a transaction about 10 years ago. So the company, we worked with the shareholder of the company. There were several very major funds, Sequoia Capital, Bessemer were 2 of the shareholders. The company was sold to IBM for $150 million or so. IBM has a policy, they are not willing to cap the IP liability. They want 100%, get hold of your $150 million back if there's an IP issue. Basically, you can't sell a company and get sued by IBM for $150 million. So the solution was to do this insurance policy. That was 10 years ago. I think it was the first transaction in Israel to bring IP insurance. I remember the cost was 3%, 2-3% of the deal. People were looking, we're going to pay $5 million now to buy insurance. That's a lot of money. But then after discussion, people decided to do it. You know, the argument was, I made the argument that if we got an offer for 145, would we sell the company or not? People said, well, probably we would. Okay, so let's do the transaction with the insurance. The nice thing about the insurance is that indeed you get all the 150 and you can make a distribution to your limited partners, and you don't have to call back the money from the limited partners down the road, which is a disaster for a venture capital firm, or keep the money in your bank account, and that reduces your IRR. And I think this is a big reason for insurance. What I've seen in the transactions I was involved in, quite a few transactions, is that people in Israel did agree to extend the escrow period and still save this $5 million in my example, because they felt the risk is not that high. There were no claims against the company. If it's a tax for insurance, the company was not profitable, so there's probably no tax liability. If it's an IP, they felt pretty comfortable with the RP, so they wanted to find a way to keep the $5 million and not pay them to the insurance company. And they're willing to extend the escrow period, say from 12 months to 24 months, or even 36 months in extreme cases, and get the full amounts. But it's interesting to see how this trend will develop. Obviously, I think the US will have a big influence on Israeli transactions, but that's my take on this whole issue of indemnity, insurance, escrow. I want to raise with risk one kind of major issue which always comes up for companies which took funding from the Israeli Innovation Authority. Maybe Rick, you can educate us a little. What is the issue, and what are the potential solutions?
Sure. I mean, the Israel Innovation Authority, which was formerly called the Office of Chief Scientist of the Ministry of Industry and Trade, provides financing for companies at very favorable terms. Essentially, there's no mandatory repayment. Repayment is made royalties out of products sold using the technology that was funded. And then there's a cap on it, and the amounts, basically the amounts of the grant plus a factor for interest and a factor for linkage to the Israeli CPI. So it's very favorable because, again, you don't pay it back unless you actually have sales, and then it's just a royalty of the sales. The problem is twofold. One is there's a restriction on your ability to transfer technology that's been funded by the IAA out of Israel. That's the major restriction. And two is it's something that foreign investors and foreign acquirers are not familiar with. My feeling is the best way to handle it is to educate them right from the outset. Because again, there should be no embarrassment having taken that money. It's actually very favorable money. The bureaucracy itself has become much more user-friendly, and there are now ways to redeem the amount needed to be paid in order to export the technology. The system actually works much better than it ever did before. And I think, again, the key when you identify an issue like this, which is something which is unfamiliar to acquirers and therefore could have the surprise factor, is simply right from the beginning to do your homework. Make sure you know exactly what the numbers are. Make sure you know exactly what the IAA would be expecting as a redemption fee, so that if the issue does come up, you're already prepared with what the cost is and you can negotiate how to address it. If you're not prepared, if you don't know the numbers, I mean, I was involved in a transaction where the company swore to us that there was going to be no redemption fee whatsoever. And then it turns out there was a $7 or $8 million redemption fee, and it almost blew up the deal at the last minute. You need to be on top of the numbers. It's not always clear. Sometimes the company has very old programs that were operated under different regimes. We also have companies that have old programs that they don't even have the documentation anymore, and nor does the IAA. It's very important to sort that out ahead of time. If you come to the table with a clear picture and you understand what the exposure is and what the magnitude is, it can be addressed. Again, I don't think there's any embarrassment of a company having taken that money. It's money at very favorable terms.
Just to add on what Rick said, the typical scenario is the company got funded by the IAA. Let's just give a number, $5 million. When the transaction happens, the first thing is that if the IP stays in Israel, there's no payment to the IAA. So the argument usually by the seller is, okay, if the buyer wants to take it out, it's his decision. It's not our fault. You want to take it out, it's your issue. It's not our issue. But the counter argument usually by the buyer is, okay, look, first of all, you got the first 5 million. So you got the benefit, so you should pay the first 5 million. The payment to the IAA is usually 3 times the 5 million, so it's up to 15 million in my example. And then there's a whole negotiation about who's going to pay the extra 10. Is it the seller? Is it the buyer? Is it going to be split somehow? And you can find all kinds of transactions. I would say in many cases it's split the second and third time is split 50-50. So in my example, we had $10 million payment out to the IAA out of the pocket of the sellers and 5 million out of the buyer. But obviously there's a lot of negotiation leverage here and a lot of back and forth. By the way, taking out the IP is also a tax event. And this one actually costs you 23%. So in my view, you always say, okay, you're going to take it out. It's going to cost you 23%. So why are you taking it out? Keep it in Israel. And the tax rate in Israel is very attractive. So keep the IP in Israel. So you don't have to pay the IAA. You don't have to pay the tax. It's the best solution for everybody. But there's always discussion. And I think it's a very big topic. And I think people should be aware of it. And when they take the money from the IAA, they also should be thinking about it in advance. What is that going to do? But if the company really needs the money, then obviously the IAA is a great solution. Sometimes they don't take the money because they have enough funding from venture capital. And so that's, I think, is very important. I think we're almost there based on the timeline, but I do want to use one last question to Gabby. And Gabby, we closed in June, I think, or it was June. And okay, so how did you prepare for the day after the closing or the 30 days after the closing? How do you integrate 2 teams that were competing with each other? What's been life under the Resolve system? Give us a little about what's going on.
So I guess we have only 1 minute left, so.
I'll give you 5 minutes, Gabby, just because.
Give me 5? Okay, great. So, but I would actually start with something that struck me like in the very beginning, very close to basically getting to the transaction sign. I read about research done by Harvard Business Review and Deloitte that more than 50 to 90% of M&As actually fail to achieve their value. You know, and one of the big reasons are related to people integration. So, you know, you just need to read that and kind of figure out now, what are you going to do about that? You know, that actually struck me in the beginning. So it was good because it really focused me as well as the new CEO about what's important to make this transaction successful, not signing, closing, and getting the money. It's actually, you know, being able to integrate these 2 companies into one successfully. And I think, you know, you have to come with a plan, a solid plan for the next, you know, like 30 to 90 days, very solid plan. And one is really focusing on the team integrations. You know, now you need to build a bridge between, you know, the teams and, you know, usually it's a multinational team. They could be in US, Israel, India, Bulgaria, and so on and so forth. But this is very challenging. So you have to build those bridges and communications. It's not trivial, but you have to set on collaboration tools such as Zoom, you know, Microsoft Teams, Slack, whatever available, and make sure there is a team collaboration and teamwork, and you start building a culture. You know, building a culture for your own company is not trivial. Building a culture to an integrated and merged company, it's even more challenging. So I would put this is a #1 priority for the first, you know, 30, 60, 90 days. The second piece is actually to align the company vision. You know what? Why actually we did what, you know, like what made the deal actually, you know, very successful for both parties, you know, like why company A purchased company B and vice versa. It's really important to message this internally to the employees and externally to the clients and partners. So communicating, you know, why we made this deal, it's super critical first days after announcing the deal. The last thing, which is, you know, very big major thing, is product integrations. If these are 2 tech companies, obviously you want to show very quickly, you know, kind of leveraging the existing tools and existing products to create like a, like a lightweight integration in order to show the business, like the go-to-market business, the sales, marketing, and everyone who is actually approaching the customers and partners, like quick value out of these two integrated companies. So making a very quick time to value product integration. And so you can actually leverage that to cross-sell, upsell, create value quickly. And so the next, few, let's say months, you can actually show already revenues out of this integration. So these are the major three items that I would actually put a solid plan around them. But number one is team integration.
Give us your personal, how do you feel personally after 90 days?
So we are 4 months out post the transaction. I feel this integration meant to be. We came from the kind of relatively same background. We both companies were selling to the same people, same IT organizations. We actually had the same DNA. Both of us were IT automation companies. Different products, by the way. One was like, very complex and kind of rich coding. And Ayehu actually brought the no coding aspect. So you bring up like an end-to-end IT automation solution for the enterprise. So it made all sense. So everything actually, like I said before, the reason why a company like Resolve would repurchase Ayehu and vice versa, about the people and the acquisition of new talents and the product market fit, all of that came all together in the right time.
Thank you, Gabby. Thank you. Okay, I think that's it. We try to keep it. We try to cover both the pre-M&A, the transaction itself, the tax issues, the post-M&A. I think a lot of things in 1 hour. Yeah, then I don't know if we have any questions from a panel from the
Only good comments.
The comments. So I want again to thank everybody for joining, especially the panelists. And I know, Gabby, you're in California, so it's just early in the morning for you. So I'm Roger from New York.
Not anymore.
And thank you, everybody. And we'll meet again in one of the next few panels. Thank you. Thank you, everyone.
Thank you.
Thank you.
Thank you, everyone. If you have any questions, feel free to email us and we'll reply.